The stock market crash of 2026 might be canceled. The AI bubble might not pop. And I'm going to explain why that might be the case. Now, to be clear, this video is not financial advice. I am not a financial advisor. This is for entertainment and educational purposes only. I'm not suggesting that you just take your life savings and dump it into the stock market today. Now, last Friday, the U.S. Department of Labor posted the December Bureau of Labor Statistics data, in addition to revisions to the months of October and November. Now, for those of you that are not familiar with the Bureau of Labor and the statistics data that they post publicly every month, in short, this is U.S. economic data such as unemployment rates and total number of jobs that is made available to the public. You may sometimes hear references to this data in news headlines, with the most recent headlines stating how 50,000 jobs were added to the United States economy in December of 2025. Now, of course, that might seem just fine on the surface, but then you look at the revisions and you see that job losses originally were reported as down 105,000 jobs in October of 2025, and that number has now been brought up to 173,000 jobs lost. Additionally, rounding out the year, 2025 had a historically low number of jobs added in comparison to non-recession years in the past 30 years. And looking at this graph here, we have the total number of jobs in the United States on the y-axis with the years in the x-axis. And as you can see, over the course of the past 30 years, every time the total number of jobs in the United States begins to flatline is usually around the time that we enter a recession and a stock market crash. Those timeframes, of course, being the dot-com bubble in 2000 and the financial crisis of 2008. Any economic data from 2020 to 2021, by the way, I usually ignore that. That's a bit of an anomaly, of course, with the pandemic. But with that being said, as you can see, 2025, the number of jobs in the United States is starting to flatline, similar to what we saw in those previous instances of economic struggle. Now, your first thought as I begin to share this might be, well, hold up a second, I thought you said the stock market crash might be canceled. You're sharing data here that supports the idea that a stock market crash might be occurring soon. Now, of course, this might be a good time to emphasize the economy does not equal the market does not equal the economy. However, the two can show similar trends. And in this situation, context is everything. Of course, the total number of jobs is starting to flatline in current day. However, we have to keep in mind that many entry-level jobs are being eliminated through the improvements of AI technology. Many of the layoffs that publicly traded companies are having right now, it's not so much to do with just trying to increase profits alone, but it's also due to these companies' investment in AI infrastructure in order to remove the need for these lower level jobs and replace them. Or at the very least, it requires less entry-level employees. And I know we've seen this anecdotally, but I have some more graphs to kind of back this up. Again, it's more data from the Bureau of Labor Statistics. Here we have the total number of unemployed people that have been unemployed for 26 weeks or more over the past 30 years. And you can see since 2023, this number has been trending upwards. And generally speaking, the other two times this number has trended upwards in consecutive years is during 2002 to 2003 and 2008 to 2010. Now, the reason I emphasize this graph in particular is because, as you can see, when the line trends upward, it's typically a lagging indicator. It's something that you see trend upwards after a market crash has occurred and after the economic struggle has begun. So while this is definitely a warning sign of a poor economy, this isn't exactly the warning sign that some people might think it is regarding the performance of the stock market. Here are two more similar graphs. The one on the left is the unemployment rate of individuals 25 years and over in the United States with a bachelor's degree or another degree of higher education. And again, we see that line trending upwards after the market has crashed, not before or during the market crash. And then the graph on the right is unemployment rate for teenagers, which, as you would assume, is going to be lower level jobs, lower paid jobs, entry level jobs, jobs that can be more easily replaced by AI infrastructure. Now, of course, this logic, this narrative that I've just introduced, that the reason total number of jobs are starting to flatline and the reason that the unemployment rates for certain groups are starting to go up, being because of AI replacing those entry-level jobs. While that has been proven to be true at some companies, that has not been proven true across all companies within the economy right now. There have been reports of some companies choosing to invest in AI and conduct these layoffs, hoping that the AI investment will pay off, but it may not have necessarily paid off yet. And therein lies the million-dollar question. Not whether or not we're going to see AI involved in many aspects of our life, but rather, is AI going to be as profitable and increase productivity at the rates that some of these tech companies are claiming within the next 2 or 3 years? I am a firm believer that AI will be in our future. It will be a part of our day-to-day lives at some point, if not already. But I am a little bit skeptical that it is going to result in any kind of significant productivity boost within the next 1 to 2 years. From personal experience, there's many times where I feel like the LLM might not even be correct when I'm asking it to perform certain tasks or functions. That all being said, I mean, the technology is still really impressive. I'm just more referring to the short-term usage rather than the long-term horizon. One last thing I should note regarding the stock market's performance in 2026 is the most recent bit of news, and that of course is referring to the investigation that the DOJ has opened into the Fed Chair Jerome Powell. Now you may have seen the memes of Jerome Powell whipping out the money printer and just letting it fly, but what he's most known for is setting the interest rates on a regular basis, and working with the rest of the board to make a decision on whether to raise rates, lower rates, or keep rates the same. And of course, this can have a huge impact on the economy, and it can also have short-term and long-term influence on the stock market's overall performance. Now, I don't want to get into all of the details of the investigation itself, but rather the statement that Jerome Powell came out with after it was announced that he was being investigated by the Department of Justice. And he publicly stated that he believes the president is threatening him with this investigation in order to get him to lower rates. Now, traditionally, the stock market loves when rates are lowered, and that typically results in some good short-term gains. And while I don't really expect much to come from this investigation into Jerome Powell, he is only the Fed chair until May, and it's widely believed that the new Fed chair that the president will appoint is going to be a little bit more of a yes man and do exactly what the president wants him to do. Or at the very least, influence the decision that the board ends up voting on, whether to raise rates, lower rates, or keep rates the same. So if rates were lowered more aggressively in 2026, I do believe that would keep the stock market from potentially crashing for the rest of this calendar year and possibly into 2027. And of course, if AI proves to be very profitable for non-tech publicly traded companies, that will only continue to strengthen the stock market's performance and potentially avoid a bubble popping or a crash from occurring altogether.